Well, hello and welcome. This is part one of our four-part series called Year-End Tax Planning Ideas for 2020, and we're getting started right now. I'm John Williams, the owner and advisor at Ironwood Wealth Management. One of our goals as a comprehensive financial planning firm is to help clients recognize tax reduction opportunities, both within their portfolio and their overall financial planning strategies. So staying current on the ever-changing environment is a key component to help clients benefit from potential tax reduction strategies. Today, and in the other parts of this series, I'd like to share some strategies that could be effective if you consider them and implement them before year end. Please also note, this workshop series is not a substitute for using a tax professional. In addition, many states don't follow the same rules and computations as the federal income tax rules. Make sure you check with your tax preparer to see what tax rates and rules apply for your state. When it comes to many things in life, we believe a proactive approach instead of one that is reactive likely leads to better results. And I definitely think that's true for tax planning. In this four-part series, we will review several potential year-end tax planning ideas and strategies that you may want to consider. We also believe in educating our clients on their choices. Our goal with this type of information is to just give a broad overview of tax planning so that when you look at your own situation, you have some strong foundational information. Please do remember, each taxpayer has a different situation, so you should be looked at individually. The good news is we are available to talk to you about your specific situation. Before I get to the presentation, I would like to take a minute to remind you, please stay healthy because your health is a high priority. Also, we are all still experiencing challenging and unprecedented times, and as I've shared before, your first wealth is your health. You know, I find it is always important to review that there are 5 key areas of financial planning, and they are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Today's presentation is about tax planning, as is other parts of this series. That can also sometimes affect your estate planning. As a comprehensive wealth management firm, we try to consider the impact of any recommendation we make, not just on one of these areas, but all of these areas for our clients. Tax planning for 2020 became a little more complicated because of the new Secure Act, which was signed into law at the end of last year. Also, the 2020 CARES Act has added some new laws and rules for taxpayers as well. And also, with this being a presidential election year, it is helpful to consider some of the tax proposals that are being discussed so that you can be informed and plan. Let's start by quickly distinguishing the difference between tax planning and tax preparation. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax forms after the end of the year. This series is about tax planning, not tax preparation. It is about hearing some proactive ideas that you can consider and potentially help reduce some of your taxes either now or down the road. You know, one of our founding fathers, Benjamin Franklin, is credited with saying, "By failing to prepare, you are preparing to fail." And we believe when it comes to tax planning, that's very true. Moving on, for 2020, there are still 7 tax rates: 10%, 12, 22, 24, 32, 35, and 37. Now, under the current law, this 7-rate structure is scheduled to automatically phase out January the 1st of 2026. Here are the current tax rates for married filing jointly as well as single filers. Married filing jointly has lower rates on many amounts, as you can see. For planning purposes, something you need to remember is that even if no changes are made to the rates, in 2026, the law says we go back to these older, higher rates. Tax brackets are important, and current tax laws call for a sunset in 2026. That means we will go back to those older, higher rates automatically at that point. So when you think about your plan, please keep this in mind. As this arrow shows, for some people that means income that would be taxed at 24% today, well, it could be taxed in 2026 at 33%. It's a much higher rate, for example. For 2020, the standard deduction amounts are $12,400 for individuals, $24,800 for married couples filing jointly, and also surviving spouses. It's $12,400 for married couples who file separately, and $18,650 for heads of household. The question is, how should you be viewing itemized deductions nowadays if you don't take one of those standard deductions that I just now went over? Well, with these new higher standard deductions that I just reviewed, the new rule is to time or plan your deductions. And two of the more widespread deductions that taxpayers look at if they choose to itemize and not use that standard deduction are your mortgage interest and state and local taxes, collectively known as SALT. Under the new rules for mortgages taken out after October 13, 1987, but before December 16th of 17, mortgage interest is fully deductible up to the first $1 million of mortgage debt. That threshold has been lowered to the first $750,000 if you're married filing jointly, or $375,000 if you're married filing separately. That's on homes purchased after December 15th of 2017. If you have a mortgage, you should check with your tax preparer to determine how much of a deduction you can take. The Tax Cut and Job Act also limited state and local income, sales, and real estate, as well as personal property taxes, to a maximum deduction of $10,000. So that collective group called SALT is limited to a deduction of $10,000. Moving on, one strategy for those taxpayers who like to give to charities is to consider what I call bunching your charitable contributions. If you're married filing jointly, as an example, and had $10,000 of state and local taxes and a $5,000 of mortgage interest, and you wanted to give $10,000 to a charity, then you would have itemized deductions that totaled $25,000. The standard deduction in your case is $24,800, so that would be a gain of $200 if you itemized. Now, if you were in a 35% federal income tax bracket, that would have an after-tax savings value to you of $70. After 3 years, that would be a savings of $210. An alternative strategy is to bunch the gift and do 3 years worth, for example. So instead of $10,000 each year, you could do $30,000 in 1 year, and then use the standard deduction in years 2 and 3. That would bring your deductions to $45,000 in year 1, saving you $7,070 over the standard deduction in year 1 at a 35% tax rate. Now, by doing this, you would lose that additional $70 in tax savings from years 2 and 3 that we talked about in the first scenario, but your total tax savings would still be $6,930 versus only $210, so that'd be a total savings of more than $6,700. Thank you for watching part 1 of our 4-part year-end tax planning series. Be sure to tune in to the rest of our 4-part year-end tax planning series for more important information. And remember, your health and well-being is a high priority. We always appreciate the confidence and trust our clients have placed in us. We'll see you in part 2.